Ladies and gentlemen, here at the second edition of the Retail Jeweler World Dubai Forum, we have an interesting panel discussion on returns on investment and gross margin return on investment, for which may we please invite Mr. Nirav Shah, the Director of Fame Advisory DMCC, who shall moderate this panel. And thank you so much for being here with us, Mr. Nirav Shah. We'd also like to simultaneously thank you, sir. It's a brilliant afternoon and we love the smile. May we please invite our panelists. Ladies and gentlemen, please dance together. I'm going to remind you once again, I know we've been in the virtual world since 1 year, but if we put our hands together, it's very good for our health and as well. So please put your hands together in joining me to welcome our panelists, Mr. Ashish Garg, Country Head, KGK Group, and Mr. Kaushik Soni, the Managing Director of Tejori Diamonds. Mr. Thomas Scaria, the Head of Corporate Finance, Joyalukkas. A wholehearty welcome to all of you. I'm going to request Mr. Nirav Shah to please take over. And this is pretty much interesting. We all talk about profits and the return of investment. So let's hear from our distinguished panelists who shall share their views. Thank you, sir.
He moderated in the morning.
Good afternoon, ladies and gentlemen. So after a very, very interesting session by Richa on pushing and natural diamonds and how to differentiate, we are going to be a bit more paradoxical, and we are going to bring to you what you need to be looking at when you actually start looking at your performance, examining your performance or evaluate performance. Now, why is that important? And I don't need to highlight this more than the current time. You all are aware. We were all through various different challenges last year. We have less tourists in the city. Customers are not coming to store because of the situation, low appetite for luxury and all of that. And therefore, we had a huge inventory pile-up, low sales and cash flow or liquidity issues, and also the price which went down except for the gold, right? But what happened? Then we saw a lot of our industry participants who were agile come out and change their behavior, right? So what did they do? They did a quick analysis, they transformed themselves, they liquidated some of the stock so that they are better in terms of the cash flows, right? So that's why we are saying that what you need to manage well is your cash flow, your focus on your return of investment or a gross margin return on, as we are going to speak about that concept soon. But the fundamental part is, are you going to look at your inventories well? And why do we stress that, Because, gentlemen and ladies, if we don't get measured, it doesn't matter, right? So, at the end of the day, we are in a business where everybody, each one of us, wants to make profits. But what is your yardstick of profit? Traditionally, a lot of jewelers, a lot of families see that, okay, I have X amount of stock, and that's in gold form, and that's my equity, that's my profit, and that gets reinvested further and further. Do you think that's the measure that you want to use going forward? And what is it that you should be doing differently? So unless you measure that properly, look at your return on investment that you're making, and look at your composition of what you're holding. Are you adding the inventory carrying cost to your calculations? And that's very important because we know that this market has huge inventory pileups. So people think that, okay, just because the gold content price has gone up, I'm okay. But you all are jewelers. I don't need to tell you more, but if you go for melting a piece, how much do you lose? And do you actually add the value to how long you are holding that piece or not? So that's where we thought, again, just to drive home the point, the jewelry, the retail is an industry which, as I say, is a working capital intensive. If it is purely capital intensive, you are building fixed assets, you will have a lot of people to lend you against. But when you are working capital intensive, that means majority part of your investment is in your inventory. And except the gold content thereof, no financial institution is going to leverage that. What does that mean? You are putting your own money in inventory. And therefore, are you actually assigning a suitable return for your own funds? What you should be looking at as a minimum yardstick for you to earn. So that's why my simple point that I want to drive home is that you need to use your assets better. And therefore, a deeper look at your inventory is not only essential, it's paramount in this time. So again, this is a concept which we just want to kind of introduce you all to, but it's gross margin return on inventory investment, and therefore, okay, there are a lot of jargons on the slide, and I need to cut that out short. What we are trying to say is very simple. You are earning gross margin on a piece, and look at what is the average inventory you hold and for how long. And if you come up and mix the two together, you come up with this dynamic concept of gross margin return on inventory investment, right? So what we are saying is that even though you think that some of your pieces earn you a very high margin, maybe 50, 60, 70%, but if you're going to hold it for a year, that may not really be yielding you the result on your invested capital. And therefore, what you need to marry is two things. Not only your gross margin that you're earning, but also how quickly you are earning that, right? So this is again statistics from US, which is one of the largest market, that all of them look at this different concepts in a different way, and they want to try and measure it in certain way in this fashion. But the point again is that what is your gross margin percentages, what is the inventory turnaround, and are we quickly turning our inventory around or not? Same level of inventory, if you turn it twice, gives you double the volume and double the profitability. But the same level of inventory, if you turn it over 2 years, your profitability is half and you don't earn anything. So it's a good measure, but again, it gives you a product category wise profitability, it tells you average amount that your inventory returns, and may indicate a potential cash crunch that is going to come in, So if you are going to look at this, it will help you identify. And further, if you go deep into the data, you will know category-wise which category is doing well against the average inventory that you held and the margin that you earned. So it can help you focus on a fast-moving category, change your inventory composition, and help you focus on getting maximum return out of your inventory. Right? So again, like any other method, this is not a foolproof thing, and it doesn't work identical for everybody. It depends on your mix of the stock, the inventory composition that you hold, the category that you hold, and therefore this measure is very good to compare internally as to what category is doing well, how much space it is using, and does it give me the same return on the space that I use or not, and all of those concepts, So, but you cannot generalize it again. You need to be selective in seeing what works well for your business particularly and use that properly. So it can help you pinpoint what the problem areas are, and therefore you can reevaluate, change all of that, and work around it. The main aim and the focus today is that we want you to have minimum but relevant inventory. Why relevant? Because then only it will generate your increased sales and profits and keep your customers happy. So we are not here to tell you that you destock. No. Keep the stock that's moving faster. Keep the categories that are preferred by your customers, and those customers will keep coming back to you for that. Right? So with that context, I would now love to discuss with my panel on how we are going to use some of these things going forward, and maybe this can give some of the feedbacks to all of you to use it in a daily life. Okay? So all right, thank you. So let me first start with each of my panelists. So Ashish bhai, would you like to give some of your opening remarks? What do you think?
Thank you, Nirav bhai. First of all, I'd like to thank Samit bhai for organizing this amazing seminar, not webinar. We have too much of Zoom meetings, so thank you for that. It's a wonderful forum, and it's an honor for me to be here, present with all the distinguished guests. Nirav bhai, when we're talking about GMROI and ROI, I can relate to your presentation very well. We are a system-driven company. We are a very delegated structure. We work on basis principles of KPIs. We don't have owners guiding us every day. So we are a professional company, and the KPIs guide our, the business. So we definitely follow the principles of ROI in every aspect of our business. For us, we are in a segment where we are in a trading category of the business in the wholesale. And in a B2B, the margins are not something which we can play around with, or there is a potential to grow more. So our major focus is on inventory and in debtors. So because that's almost constitute 95% of our working capital. So the more we turn that, more we are going to get margins or the return on inventory or in our investment. So that's why I feel, you have really hit the nail on the head. And as a trading side, I really, agree to all your points.
Thank you, Ashish bhai. So Kaushik bhai, you want to add to that from a retail perspective?
Yes, thank you so much. So starting, the first thing I'd like to say is, well, besides thank you to Samit bhai and the whole team here for getting us on board. The fact that what a stark contrast between the previous presentation and this one. The previous presentation I could relate to on a one-on-one basis, because being an independent retailer, we are taught, or we teach our team always to be emotional about the pieces of jewelry. Yet when we are talking about this is hardcore number crunching, and what we are looking at how to emotionally detach ourselves from the very same piece of jewelry and look at hardcore numbers. We have always followed, besides our audits, we've done our age analysis, we do ROIs, but we don't do GMROI. The prime reason is because what we have is a very large and diverse range of products. This is something which retailers in Dubai will probably understand. Most of the independents, we stock just about everything. From the smallest to the largest, from the everyday piece to the luxury, and we are very sentimental about all of them. We tend to fall in love with our pieces. And I think this is what our panel today is about, that we want to be sure that while we admire our pieces, we probably should not be in love with them. And how we go about following on, and what decisions do we need to take so that we don't become redundant, so that we stay valid. So when the markets are down, we've been in this situation where now we are flooded up to our noses in inventory, and the trend has changed, and now we are stuck because we don't have the cash flow to go in for the new trends. And we are still waiting to offload our previous inventory, which nobody wants to buy anymore. How do we go about doing that?
So I still remember somebody in the industry once told me that your passion for your goods is one side, but if you love it so much, try and sit on it for 5 minutes. And if you can, then you hold it. Otherwise, don't. So, Mr. Thomas, can you add something on that?
Good afternoon. It is great to be here on this lovely panel on a subject which is very close to the heart and very interesting at the time. Just to refresh your memory on certain concepts around which retail jewelry strategy had evolved in the past. Certain concepts and thoughts like big brands used to say that we should have a store in every shopping mall. we should have a store in every prominent location in UAE. Concepts like it is okay to do in a market cannibalization situation where your same store compete with the same store next door. It is acceptable to have 25-30% of your branches not reaching break-even sales if you have a X number of stores which are doing really good and eventually those are compensating the bad performing branch. So those concepts are outdated post-COVID. What is really matters is only customers. In all our business discussion and interaction, we talk a lot about putting customers first and customer-centric approach and all those things. But I believe rapid expansion of stores has actually given up knowing deep about the customers. So big brands, especially like chain retail stores, they realize that it is a time to embrace customers than preserving your location. So as a famous saying goes, your top line is your vanity. You can boast about it. Your profit is your sanity. You can work on, improve on it. But cash is the ultimate reality, so you should embrace it. So metrics like gross margin, return on investment and inventory is something like a proxy to a cash flow. Because it talks about two major things. One is your brand's ability to recover higher margin on a given market situation or a competition in a given set of customers. Second, your ability to turn your inventory. So these are the two major components in a jewelry retail business where we should be more concerned about it. As a retail brand which operate in multiple countries, we give a lot of importance on this particular metrics in our daily ROIs or KPIs.
Thank you, Mr. Thomas. So how do you think or what are the specific, say, KPIs that you use or performance metrics that you use currently to measure your performances, say, for example?
Within the industry, I think there are different set of parameters followed beginning from manufacturer to wholesaler to a trader to a retailer. I think it's not a rocket science for a retailer like us. We always look at when you invest in a new country or start new branch in a location, we always look at the number of years it required to pay back that particular unit, the actual cash payback period of that particular unit. And secondly, for those successful businesses which are continuing in good, especially in branches which are doing very good, the ability of their that branches to return the growth rate they can bring into the equity of the shareholder. That is the second parameter for those branches which are continuing after the payback period.
Okay. Kaushik, so from an independent retailer perspective, how do you look at it?
So the amazing difference that one of the things I realized is a corporate looks at seeing how they can return the money back to the investor. And an independent generally considers his shop or his store or his inventory as his wealth. And that's a key fundamental difference. So the problem is we do not consider opportunity cost. And that's the reason we lose out. Because we feel that, okay, I have this piece of jewelry, fine, it's been sitting with me since 2013. I'll sell it one fine day, but if I don't, at least I have it. And it's not losing value. What we do not probably realize, or most independent retailers or most jewelers who follow this technique do not realize, is that they have lost the money, or if you're working on a 20% margin or a 30% margin, you've lost that 30% 7, 8, 9 times in those 8 or 9 years. If you were turning your inventory once over, if you were turning it over twice over, you've lost 140% on that money. So it's a ridiculous amount of income that you have foregone simply because you are not considering the investment as that and considering it as your wealth.
No, but that's very true because a lot of this independents think that their wealth, like I said, is in their inventory. Yes. But then you don't consider that how long you're carrying that and are you adding an opportunity cost to that or not, and that's where the difference lies. So from an wholesaler perspective, Ashish bhai, what would you look at? You say you're driven by KPIs. So what's your standard KPIs?
See, as we start business, one thing we are told is that, rule of thumb, is that, if you're not making more money than a market interest rate, then you are not doing a business, you're just doing charity. So that's what we follow. And as I said earlier, that gross margin is something which we cannot really play around with because of the competition we are in. So we focus on, the inventory turns and ultimately ROI. Another thing that is important for us is because we are in a variety market, diamond, could be from VVS to PKs, we sell to a variety of retailers. So we are selling to somebody who is buying a VVS, somebody who's buying a PK, who's buying a SI, and somebody who's buying a smaller diamond, somebody who's buying a 1 carat, somebody buying a 10 carat. We have it all as a company, as a group. We are, one of the largest. So we have everything. But for me, in this market, I have to decide what will give me the maximum returns. I cannot, sell everything in this market. So I segment and choose which is the best option, which is the best area for me to give returns back to my company. So I segment my, product profile and then decide where I'm going to put my money in so that, the returns are good.
So you're already segmenting your inventory and you're looking at your performance from that focus already, right?
Oh yes, we have a 5-page MIS that every month get, measured, and we are, telling it to our team. Our teams are looking into it. We are looking into it, and we obviously, as a professionals, are much more accountable than maybe the owners, and so we obviously have to give that, performance back to the company.
So Kaushik, turning to you, what do you think a concept like a GMROI or anything can help you? Does it really make sense from your perspective?
Absolutely. What happens, as I said, with retail, or especially retail in a place like Dubai, where it is extremely competitive. So the moment a retailer, we see somebody doing something, the idea, or generally what we notice is a lot of retailers tend to, they want every single product that they see in someone else's window in their own window as well. No harm in it. It fosters competition, perfectly fine. But what a lot of people don't realize is that, do you really have a specialty in that product, or are you going to sell enough of it? Or are you simply imitating some other window which does not add to your bottom line? And you may buy into a product looking at someone else's window. He has an entire thought process behind that window. When he has done something, if you are simply following and if you're not able to sell enough of it, now this happens when you don't have enough product categorization. So a lot of retailers I have seen this, where a lot of retailers have started doing this. The corporates have always led this. We've seen this in their marketing campaigns and in their promotions. But a lot of independent retailers have started doing this, where we see distinct product categorizations. And it's obvious when they're doing that, they're measuring those. And once they are measuring them, then they are redirecting their investments in those specific products or those product lines. And I'm sure that they are seeing mutually beneficial results in there.
Mr. Thomas, how do you see this kind of a concept, or is this something that is, is this something that you're already following in your performance in different ways, but is it something that helps you kind of focus or no?
Definitely, this is not something which is new to us, but the beauty of this concept is it can talk a lot about the other functions of business, like it can talk about the kind of profiling you have on the product side, on the supplier management side, especially your sales and marketing strategies, your staff skills, the kind of strength you have as a brand to charge higher margin on the product. So it's very, very wholesome in that approach.
So if we look at this from a UAE market perspective, Ashish bhai, what do you think in your segment, in this market, this kind of a focus, how is it going to help, say, a wholesaler like you, who is focusing, like you said, on every possible categorization? So how do you think,
See, basically it helps you focus on a certain segment. So once you focus and you measure and you track your performance matrices, you can take corrective actions, and you can focus on your star sellers, put more investment in those areas, and come out of the segments which are not moving. So it's a very important thing that we need to take corrective actions for whatever we are doing in past. And COVID has definitely taught us that nothing will remain rosy. We cannot just grow maybe with Dubai growth. We need to individually, every company has to come out with its own growth strategies. Understand that there are a lot of pitfalls in and around, so your money should give you the best returns.
Kaushik bhai, if I look at it a bit differently, what do you think is more appropriate segment or performance indicator which helps you be more agile, more flexible, because that's the requirement of the market today, right? So what do you think can help you? Forget this concept, this is one of the things, but is it something that can help with the focus which you can bring, and what can help you be more agile and flexible, to take on this kind of a challenge?
That's why I'm here to learn. This forum, I'm hoping something, it's difficult to tell what makes one agile. But like, they just said here that cash is what will allow you to be agile. If you may have all the inventory in the world, but liquidating it is going to come at a very, very steep cost. So unless you are maintaining or unless you are able to generate cash, now that can happen in a good market. It was never an issue. So people never looked at cash flow. Everybody usually looked at their bottom line, and they looked at the balance sheet at the end of the year and they said, "Okay, I made so much profit at the end of this year, fantastic year, God bless, pat my shoulder, move on to the next one, and let's open another store and add more inventory." But there was never any inventory analysis. There was never really any customer bifurcation. There was never any targeting of a customer. All of this has happened in COVID. Suddenly everybody has had to turn those pages, go back, look at the things. And now we are looking at how do we become more agile. So how else will you become agile? When the market stops and when you are unable to sell your product, then you should have, what is your plan B? Do you just simply go out and melt it and take a 30-40% hit? Or are you segmented enough upfront to know that, all right, this is what my customer profile is and I will be able to sell this if not today and tomorrow? One of the examples that we were given in the earlier presentation was, why can't we have a collection for every season? Well, one of the reasons is for two reasons, because we don't have the same ROI on our product as the fashion industry does. They can have $100 products being sold for $5,000 because it's a garment and people will pay for it. But we are unable to sell a $100 piece of jewelry for $5,000. So we don't have that margin to go out at the end of the season and have a turnout throwaway sale at 70% discount or 80% discount or 90% discount. We can't do that with our jewelry. So what else do we do then? So how else do we target? Then that's where the whole point has to come into it.
I am fully with you, but then should you not be following that yardstick of creating that kind of a margin in the business to look at it differently? It's just a thought, yes. Like you go to brands and they are still doing that. Of course, they have limited collections then, So it's a way of approaching it differently maybe.
If the industry is with me, I'll be the first one in the line to increase my margins.
True. Mr. Thomas, coming back to you. So any other suggestions on any other, performance metrics or anything that you would like people to kind of use?
One new KPI, which it's not new, it's old only, but we had been underplaying it in the past. Same growth in sales and profit in same store. This was never seen as a factor in our, especially large chain retailers. We always focus on the number of store we add in our chain and the top line year-on-year growth. So I think during the recovery period, during this transition time, same store growth in sales and profitability is going to be one of the key KPI, which we are very consistently and very rigorously following.
Okay, so what is more interesting is that therefore one needs to focus on this particular aspect very, very closely. And we couldn't have stressed that more than, what we have discussed just with all the segment from a wholesale to retail to an organized retail segment. So I would invite Ashish bhai for your closing remarks, then we can
From my
What do you
side,
think should be the message? What one should be looking at, and where you think we can look better?
see, I'm a very young guy to give message to all the distinguished guests here, but from our working style, I'm really blessed to be in a company like KGK, which really is a corporate structure, working in a very professional manner and working with a lot of scientific and financial tools in hand. And that's what I can say, that we just need to measure all our matrices and take decisions based on it. Yes, gut feeling is always very important, but when it is coupled with your matrices, the facts and figures, it really makes a big difference. That's what I can say. Thank you.
Okay. So thanks a lot, ladies and gentlemen, for the attention, and thank you, Samit and everybody, for inviting us for this. Thank you all. Yeah.
Thank you very much, Mr. Nirav Shah. I'm going to request you all to kindly step forward to the group photo op, and thank you. What a great vision, and we all looking forward to all the solutions for all the challenges that we faced since the past 1 year. And thank you to our distinguished panelists for being here with us. Ladies and gentlemen, with us, Mr. Nirav Shah, the Director of Fame Advisory DMCC. Please continue the applauses as we also thank our distinguished panelists, Mr. Ashish Garg, Country Head KGK, Mr. Kaushik Soni, Managing Director Tejori Diamonds, and Mr. Thomas Scaria, the Head of Corporate Finance, Joyalukkas. Thank you.